Hey there, this is Dario Kerkez, Certified Financial Planner with IHT Wealth Management, and today we'll be talking about portfolio diversification. So, in addition to the power of investing early and often, it's very important to consider diversification of your portfolio. Namely, when we start talking with the clients as far as the portfolio design, and we need to align the client's goals and objectives with how that portfolio is going to be designed and what asset classes will be in it. Specifically, it's going to be a short-term, longer-term. Are we susceptible to the volatility or not? What type of a volatility we can tolerate, meaning how much that portfolio in the upside or downside can be tolerated, how much it can go down specifically. So with that in mind, we have to start with something that's called a portfolio core. Portfolio core is comprised with mostly equities, and it can be the U.S. equities, and they can be international equities or emerging market equities. With equities, we consider that of a stocks, companies, stocks specifically, companies like Apple or something smaller like the Lululemon or something even smaller that we never actually even heard of. Also, they can be international companies like Nestle or Toyota, or it can be emerging market companies like in China, Alibaba, whatever. So all of those are companies that are for which you're becoming a partially owner of these stocks. On the other side, second asset class would be the bonds. The bonds can be a U.S. debt, government debt, or it can be an agency debt, like mortgage-backed securities, or it can be the corporation debt, like a company issuing the bonds, or it can be high-yield bonds, which is considered like a high-yield or junk bonds, the companies with lower credit ratings and stuff like that. So all these combination of stocks and bonds can create a core portfolio, and then we can add certain diversifiers. Diversifier is usually something that we can include in the portfolio. Usually it's between 20 to 25% of the portfolio. The reason being to break that core and introduce new asset classes, that is because they are uncorrelated to the core portfolio, meaning they're not moving in line or opposite to whatever is happening with the market. They're just completely uncorrelated. Why? Because the commodities, let's say, they're not moving in line with the market or the bonds. Real estate might move or not together with the overall market. Specifically, different types of real estate can be commercial real estate, or it can be the real estate investment trust, it can be residential real estate like MBS, mortgage-backed securities, etc. Now we can have a basket of commodities. Different commodities can track different commodities baskets. Also, we can have the precious metals like gold and silver, platinum, and stuff like that as the additional asset class that is not correlated with the market. Now, these diversifiers are increasing diversification, which means they're reducing overall risk, even though these asset classes, they have specific risks of their own, right? So emerging market has a potential risk of emerging markets, right? But that additional risk, if calculated on as a standard deviation risk or on the mathematical formula that was explained by the Markowitz in the efficient market hypothesis, or the modern portfolio theory, will actually came to conclusion that the introducing an uncorrelated asset class will be reducing overall market volatility of portfolio as a whole. So if you need any help as far as looking at your specific asset classes you have in your IRA or 401k or your portfolio as a whole, feel free to give us a call, email us, or send us in a statement. We'll be happy to analyze that from the different levels and see in case there's a possibility that the overall risk can be reduced, in case the performance can be enhanced. Keep in mind, though, that the diversification is not eliminating risk. That's not the point of that, nor it can actually guarantee any returns. Diversification is there to manage risk and manage portfolio in a way that is in alignment with your or with the client's goals and objectives, whether that is retirement goals or saving for retirement or for any other purpose. So basically, we can keep those asset classes in check inside a portfolio, and also rebalance that gradually over time so we can stay in certain percentages inside a portfolio, so we are not subject to the increased market volatility as what's happening right now. So I hope this helps. In case you have any questions, feel free to check us out on the link below, or give us a call or send us an email, and stay tuned for more videos. Have a nice day. Bye.